Hello traders and welcome to the London Forex Broadsheet's weekend wrap of the markets. The euro finished the week lower against the dollar and continued the 1 week up, 1 week down pattern that has been in place for 8 weeks now. Trade was quiet on Friday as trade desks absorbed the July options expiry moves and plotted their euro-based trades for the coming week. The markets have seen 3 attempts on the weekly chart to break above the 6,000 level and hold this year, and it now looks as though the path of least resistance is lower. The upcoming sessions are quiet for the euro economically. The pair is trading around 1.5850. The 4-hour chart reveals a pair that is at a major support point. The read on market sentiment that we get here is something to respect. The chart is reflecting market indecision in accepting fair value at 1.6000, but also not yet ready to adjust that fair value below 1.5800. The calendar is light this week on the euro, and that may allow sentiment to play a bigger role in where the pair trades than would normally be seen. If the trend line breaks, the moves will likely come in 30-pip channel runs, and will therefore need attention paid to good money management and percent of account exposed. Until a new short trend is formed, maybe look at running with half the regular number of lots. The pound reversed from the moves up to 2.0160 that it made earlier in the week, and now looks a little lost on the daily and weekly charts. The pair has taken support from the 200-day simple moving average area at 1.9950. A break below that point may draw in automated orders and pressure the cable valuations. The coming week reveals a lot about the UK economy, with house prices, Bank of England data, and retail sales numbers all being posted. The pair is trading around the 1.9980 area. The pair is still in an upwards trend and holding better than initially thought. The 1.9950 area offers support from recent trade, but looking under there, the drops could come fast down to a 4-hour trend line. It was only a week ago that the markets were setting up 2 days of smash and grab on the dollar. Maybe the tables have turned, and on a pair that has no commodity link to limit the moves, we could see it testing the cable buyer's resolve. The Aussie created a weekly chart doji candle, which is a reversal signal, and may now technically reveal a change in market sentiment on the pair. There was downwards pressure all day in US trade, but just not enough momentum to really get things moving. The top of the daily chart channel is at 96.50. The moves lower in gold prices may further pressure the momentum that was seen recently, and the upcoming PPI and CPI reads will likely instigate moves. The pair is trading around the 9700 area. The path of least resistance is following the short Aussie traders as they try to push things lower right now. Short trades are against the major trend, so maybe trade with half the number of regular lots. The 4-hour channel top is about to get tested, and with gold prices dropping, we may see a move back into the channel. The pair got within 150 pips of parity this week, but there looks to be a market-wide change in sentiment on the pair in the near term. The technical reflection in that sentiment can be seen on the weekly chart that formed a doji reversal candle, and the fact that the pair hugged the low of the day for the US session on Friday. The loonie was pulled both higher and lower in trade on Friday, and then closed at the opening price. Canada revealed a leading index report that showed the US is weighing on economic expansion in the region, but that wholesale sales reversed things with a read that was double the expectations. The pair has no real traction either way at the moment and is likely to stay that way until CPI and retail sales numbers are revealed this week. The pair is trading around the 1.0050 area. We are stuck in a range on the loonie. It really could spin either way and is hard to really get a good read on intraday trading. Right now this looks to be the least appealing of the major pairs, unless you are trading the patterns of trade on a 4-hour chart. The Swissy rose for 3 days in a row this week as traders reacted to the positive moves made on equities and chose to buy into the higher treasury yields that the pair follows. All of the SMA areas are above the pair, acting as resistance to any more bullish moves. The Swissy reveals PPI numbers on Monday. The pair is trading around the 1.0250 area. The markets have created a great setup technically on the Swissy. We are either going to reverse off the trend line on weak US dollar trade and head back towards parity, or we are going to break topside, picking up momentum of the market resetting fair value and start to target the previous trendline resistance points. The yen lost ground on Friday and allowed the dollar to make great strides higher that now run it into resistance at the 200 SMA area just above 107. Positive equity trade has allowed trade desks to buy into the yen cross pairs. We have started to witness signs that the market could be using the bounce off the pair's 100-day SMA at 104 as a springboard to finally clear 108.50. The wall of worry that has surrounded equities has not impacted this pair at all, and if anything has shown the resolve for buying into the US dollar yen that is strong. A close to the high of the week is a bullish signal. Japan is closed on the first day of the trading week for the Marine Day holiday. The yen is trading around the 106.80 area. This is a crystal clear reflection of the market sentiment right now, and offers great potential for yen bulls and bears alike. The 107-108 area has been a roadblock for this pair, and finally breaking topside will create huge market momentum as trade desks and automated software reset their new resistance levels in response. If the market decides that another failure is in order at these levels, we can retrace the recent moves lower. Either way, long or short, the instigator will be positive or negative equity market trade. On the upcoming economic calendar, Japan is closed on Monday, and as such, the trading week will really not get underway until European traders hit the floors. That leaves us with the strange situation in that the Aussie PPI numbers, which normally move the pair, may have to wait for follow-through. In Asian equities, the region closed out its fifth week out of the last 6 in the red, dragged lower by a fear that the global economic outlook is not going to easily sustain itself in the months ahead. There was no follow-through of the positive trade that Wall Street had developed earlier on Thursday. The MSCI Asia Pacific Index lost 1.1% to 129.42, whilst the Japanese Nikkei dropped 0.7%. Dollar movement was flat during the session, as were the moves of the commodity markets. European traders were not detracted by the doom and gloom coming from the Far East. European traders kept on the positive side of the equity markets, buoyed by the chance to close out their first weekly gain in nearly 2 months. The three main markets, the German DAX, UK FTSE, and the French CAC 40, all added over 1.5% on the day, and left spirits higher than had been thought possible at the start of the week. Wall Street climbed a wall of worry on Friday over the inability of the mighty Google to increase ad revenue in line with expectations. The internet giant affected market sentiment across all sectors after reporting in the Thursday aftermarket that they had disappointed in their numbers. Google dropped 10% or $50 and had a negative effect on sentiment. The markets are into their earnings swing and will be seeing some big sways back and forth in daily trade. The S&P finished up 0.4% at 1260. The Dow Jones Index was up 0.4% at 11,496. The tech-heavy Nasdaq fell 1.3%, which reflected the Google pain, to 2,282. A quiet currency session with no desire to move too far. Gold dropped heavily, off 1.3% to 958, while oil was lower by 0.3%. Gold and oil prices dropping may help the dollar appreciate. The daily equity swings are likely to be reflected in the dollar and yen cross-pair moves as the markets try to eliminate the wretched fear of loss that has things in its grip right now. Crude oil closed lower at 128.88, off 0.32%. This is the fourth day of negative selling and the biggest weekly decline in 4 years. Gold closed lower at $9.58, off $12.70 or 1.3%. Overall, the markets on Friday revealed either dollar strength in the yen and Aussie, or dollar consolidation in the euro, pound, Swissy, and loonie. There was no dollar selling, and that sets up an interesting scenario going into a new week of trade that will be absorbing a wall of CPI and inflationary data from around the globe. With dollar fundamentals pointing to a possible long bounce, equities moving into the green, gold and oil going lower, we could see some of the recent dollar index consolidation above support at 71.50 move towards distribution of the 12-month-old dollar short positions that were created when the credit crisis hit. It looks as though an increase or winding of the carry trade is happening. There is a long way to go, however, before the fear of currency depreciation outweighs the interest garnered.
All contents of the LFB are for informational purposes only and should not be used as a replacement for research by an individual investor, trader, or licensed investment professional. Neither the LFB nor any of its affiliates shall be liable for any errors, omissions, or for any actions taken in response to the information contained herein. We hereby make no representations or warranties regarding the accuracy of any information contained in this broadcast or on our site. Forex market trading involves special risks and may not be suitable for everyone. Each investor or trader should assess their financial situation and risk tolerance before proceeding. Copyright 2007, LFB Services, LLC. All rights reserved.